Finally, after using these market averages and indices since the beginning of the semester, we're going to actually discuss them in detail and learn which ones are important and which ones are not so important. Slide 47, market averages and indexes or indices. How can we say that stocks have returned approximately 10, actually closer to 11% over the past 90 years? Well, the industry uses market averages and indexes. They are benchmarks, standards, used to measure the general behavior of securities prices by reflecting either the average price behavior, that's a market average, or the relational price behavior, that's a market index, of a representative or representative groups of securities at a given point in time. Huh? It's just a list of stocks. That's all it is. Or bonds if it's a bond index. You cannot help but hear about these every day in the news. The Dow went down, the Nasdaq went up. What are they talking about? They're just talking about lists of stocks and how they did in any one day or did over years or decades. There is a difference between a market average and a market index, but it's very subtle and most people don't even know that there are differences. For example, the market average uses a share price calculation, and the most popular and well-known average is the Dow Jones Industrial Average, the Dow. It looks solely at the price of the stock without regard to its market value, how much the company is worth. Whereas a market index is a market-weighted calculation. It looks at the market capitalization, and we'll learn how to calculate that later on. It's the stock price times how many shares are outstanding. It takes into account the relative market value of the stock in the index. So in other words, the larger the company, the more influence that stock will have in the index. And the most popular one here is the Standard & Poor's 500 index. And we've used both of these and discussed them throughout the first part of the semester here. Market-weighted calculations were generally regarded as a better measure until the bubble of the late 1990s, and then they realized that nothing's perfect, nothing we humans have ever done is perfect, and that's just something we have to be aware of. The Dow, slide 49, the Dow Jones Industrial Average. It's a stock market average, meaning just they look at the price, made up of 30 high-quality stocks selected for total market value and broad public ownership and believed to reflect overall market activity. Don't you believe it? It's only 30 stocks, and most of them are not industrial stocks anymore, not industrial companies anymore. So it's a very poor measure, but it's the most popular, and we're stuck with it. Oh well. It's certainly the most famous of the stock market measures, started in 1896 by Charles Dow. You've heard of the Dow, right? Charles Dow, he and his friend Mr. Jones, I forget the guy's first name, started Dow Jones, the company that publishes the Wall Street Journal. It changes from time to time as companies and industries evolve, and as such, it has more non-industrial stocks than industrial stocks. Dow Jones is the company that publishes the Wall Street Journal, but in 2007, it was published by Rupert Murdoch of Fox News fame, who really wants to own all publications. And it appears that they sold the Dow Jones Industrial Average and all their other indices to Standard & Poor's, but maybe not. Maybe they didn't actually sell them. Maybe they licensed them. I don't know. I can't figure it out. If you can, please tell me. There's some relationship there, and it's an interesting story. The Bancroft family, who are the heirs to the Dow Jones fortune and owned the Wall Street Journal and Barron's and Market Watch, They didn't want to sell. It was a privately held company, and it was generally regarded to be worth at the time around $3 billion. Well, Mr. Rupert Murdoch offered them $5 billion, and some in the family said, "No, we're not selling it to Skunk News, Fox News, Weasel News." And others said, "Shut up! Do you realize what he's offering us?" So they sold it, and it has changed quite a bit. And such, they don't even manage it anymore. Figure that one out. Well, here they are, folks. Here, as of 2021, August, September, here are the 30 stocks in the Dow Jones Industrial Average. And it's been changing more rapidly now because like technology changes and companies merge and do all kinds of crazy things. And so most of these companies you'll know, some of them you might not know. Who's Salesforce? I mean, what is Cisco? What is Merck and Pfizer? No, they kicked out Pfizer, right? I'm sorry. They don't. Pfizer's no longer in there. But certainly you know Apple and American Excuse and Home Depot and Johnson and Johnson. Who's Honeywell? They make you've used their products because every time you turn up your heater, turn up your air conditioner, you're probably using a Honeywell device. Goldman Sachs, Government Sachs. It's an investment bank, but they call it Government Sachs because many of the people who work at Goldman Sachs wind up in the government, and then they wind up going back to back to Goldman Sachs after they're the Treasury Secretary or the Federal Reserve chairperson or whatever. Now, notice, folks, the some of these companies are relatively new. I mean, Walmart wasn't around, in 1896. None of these companies were. Johnson and Johnson was. In fact, the one company that was in the Dow since 1896, General Electric, they got kicked out. I don't know, quite a while ago. So when people say the Dow is where it was 10 years ago, or 30 years ago, or where was it 20 years ago, you got to realize that it's not the same average anymore. The list changes. So it is an imperfect measure of the stock market at best. And in the case of the Dow, not a very good one to begin with, in my humble opinion. But as we said, we're stuck with it because it's the most popular. It's the one that they will always report it on the nightly news or the websites and the like. There's a cute little quick document and commentary that we want you to look at 87 years ago. So definitely check it out. Definitely check it out. It's in Canvas and on the website. We ask you to go back in time. We give you $10,000 and go back in time and buy one of these companies. Now, as we said, I mean, Microsoft wasn't, Apple, they weren't around 87 years ago. So what you would have done is you would have bought the company before them and see how you do. Yeah. So do that. It's a great little exercise to do. It's wonderful in the face-to-face class because we tape them shut so they can't open them, and then and then we ask people to come which company they want. Oh, we want Coca-Cola. We want Disney. We want a lot of people like Coke and Disney. Slide 51. Other Dow Jones averages. The only one you're really going to hear, or at least two we'll discuss in it, they're actually important. The one you might hear about is the transport average. It's 20 railroads, airlines, freights. Many individuals will look at these companies, the average, how the average does, as an indicator, a leading indicator of how the economy is going to be doing. Because before the stuff can be built, it's got to be shipped to the place to build it. And then once it's built, it's got to be shipped to where it's going to be sold. So people will look at the transport average. The utilities are, relatively boring for people, for us boring people who love dividends. And you put all three of those together, you get the 65 stocks composite average. Now these two we'll come back to in a little bit because they're actually very important. The Wilshire 5000 and the Wilshire 4500 is what they used to be called. Then Dow sort of made some kind of a deal with them, and they called them the Dow Jones Wilshire 5000, the Dow Jones Wilshire 4500, And now they're called the Dow Jones U.S. Total Stock Market Index and the Dow Jones U.S. Completion Total Stock Market Index. And who came up with these names? I don't know, but they should be spanked, in my humble opinion. The 5,000 measures is meant to measure the total stock market, the large companies, the mid-sized companies, and the small companies. The 4,500, which I think is a much better name for it, the Wilshire 4,500, takes those same 5,000 companies and takes out the top 500, the 500 stocks in the Standard & Poor's 500, traditionally the largest 500 companies in the United States. That might sound familiar. We'll come back to that in a bit. And then we include this one. There are dozens and dozens of them, folks, but we include this one because it's yet another example of why it's not smart necessarily to follow the next big thing. The Dow Jones Internet Index came out as the internet bubble was just about ready to burst. Gotta do it, you gotta get involved because it's blue skies, sky's the limit, productivity gains. Who cares if these companies aren't making any money? It's not important. This is the future. Everybody's going to be working from home, and you're not even going to go to the grocery store anymore. Everything's going to be... That was 20 some odd years ago, folks. And the Dow Jones Internet Index proceeded to fall 96%. 96, folks. Yeah. That means you had $1,000, you now had $60. So finally, let's take a look at the one that's probably the most important index, although they're all important to be, not all of them, a few of them are important to watch to see what's going on. The Standard & Poor's 500 composite index, usually just called the S&P 500 or just the S&P, even though S&P has dozens and dozens of these things. These are 500 stocks chosen for market size, liquidity, and industry group representation. It is a market value weighted index, meaning the larger the company, the greater the influence in the movement of the index. Traditionally, as we said, they were the largest 500 companies based in the U.S., and then they started letting in some foreign companies. For example, in the mid-90s, Daimler-Benz, Mercedes-Benz, bought Chrysler. And here was one of the largest companies, a storied company in the United States, being bought by a German firm. What do? They let it in the S&P. They finally said no more foreign companies. But there was a cute saying. They changed the name to Daimler Chrysler. And the saying was, or the joke was, how do they say Daimler Chrysler in Germany? Daimler. The Chrysler is silent. And then they finally sold Chrysler and took a horrible, horrible loss. They bought it for like $36 billion and sold it for $6 billion or $7 billion. Now, the S&P 500 is very popular and used by many index funds. And if you did the bonus assignment in the mutual funds chapter, you saw that it's bizarre. It's absolutely bizarre. The top 10 companies, the top 9 companies, because one of them is duplicated, Google, make up almost 30% of the index. You see, because the S&P 500 is market weighted, it was affected by the internet bubble of the late 1990s, and now the FANGs, we don't hear that term much anymore, in a bizarre manner. The market values of a small percentage of technology companies were inflated to extremes and skewed the index even more toward those companies. Consequently, in 1998, 10% of the gain in the S&P 500 was due to one stock. This same phenomenon is currently in play with the top 10 companies having an outsized influence on the index. And this is one of the things I point to when people say, oh, index funds are the fail-safe, superlative, perfect investment. And I say, oh, yeah? You're buying the S&P 500 index. Oh, yes, that's what Warren Buffett tells me to buy. I know why he does. And so I'm sure that that's the perfect investment. Well, did you know you're getting 30% of the top 9, 10 companies in the S&P 500? Do you think you're broadly diversified? Should we change the name from S&P 500 to S&P 10? The top 50 companies make up over 50%. Think about it, dear students. Oh, and by the way, why does Warren Buffett say that? He knows. He's a shark, folks. Comes across as a grandfatherly figure, and he'll steer you in the right direction. He knows that people are going to panic. He knows what's happening, and that the S&P 500, these companies are being uh, um, pushed to extreme values, and it's like a feedback mechanism. If you know anything about engineering, the mutual fund index mutual funds must buy these stocks. They have no choice, right? And so people pour more money into the index funds, so they have to go buy more of the stocks, and the ones that are already very expensive become more expensive. And so the you see it pumps up the index even more, and people turn around, starts putting more money in because look how well it's done. And the same thing happens on the way down. When people start pulling money out, then the index fund manager can't say, you know what, this is a great company and it's hit on hard times, I'm going to buy it. No, they have to sell. So it becomes a feedback mechanism going down. And Mr. Buffett knows that's going to happen. He's not stupid. He's seen it happen many times. And he pounces when the market falls precipitously. So we'll see what happens. We'll see. Maybe Payano will be shown to be a fool for not just buying the S&P 500. We'll see. Slide 53. Standard & Poor's has dozens and dozens of other thousands. I have a hard time believing that, but they say they have thousands of indices. And so the industrial 400 is kind of like the Dow Jones Industrial, but it really does have industrial stocks. The mid cap has medium-sized companies. The small cap has small-sized companies. We'll talk about what mid cap, large cap. We already did a little bit. We'll get into that in more detail. So you put the 500 index, which is the large companies, the mid cap, and the small cap, you get to 1,500. You don't hear about these. Every once in a while, they'll talk about them on the news. And then there are transportation, utilities, financial, global, international sector indices. Go to the S&P website, and you'll see all the dozens and dozens, hundreds and thousands of them. But the only one you really have to remember is the S&P 500. The New York Stock Exchange, the Amex, both have their indexes, and they're sometimes reported in the news, but not usually. The NASDAQ is reported in the news. Why is that? Because it's often called the tech index. Remember, we said that the NASDAQ was the place where many tech companies started and then decided to stay there. Now, there are other companies that are non-technology companies, and so they have a index 100, but that's not reported too often. It's the composite index that's reported. The NASDAQ composite went from 800 in 1995 to 5,000 in the year 2000, and then dropped to 1,200 in the year 2002 before starting to recover. And people in that time would say, when's it going to get back to 5,000? Well, eventually it's going to get back to 5,000 unless the world ends. But it won't be the same list. It won't be the same NASDAQ because many of the companies that pushed it up to those nosebleed heights like America Online, AOL, are gone or a shadow of themselves. I mean, AOL is still around, but it's not now. I think Verizon's going to try to sell it off. Verizon eventually wound up with it. So you see, don't let anybody say, oh, the NASDAQ is where it was 20 years ago. No, it's not, because it's not the same list. They're imperfect to begin with from the get-go. So just, sit back and relax and nod your head and say, oh, yeah, isn't it a shame? Or isn't it great? Whatever. Now, we discussed these two that are important, and we know why now. The Dow Jones Total Stock Market Index and the Dow Jones U.S. Completion Total Stock Market Index, which is, I'd rather call them the Wilshire 5000, the Wilshire 4500, because they're very popular with index funds. In fact, if you remember your assignment on the Thrift Savings Plan, one of these was used in one of the funds. Do you remember which one? It was the S fund for small companies. But as we asked you to look up, some of the companies really aren't small. Kind of a untruth in advertising example. But that's the idea. Capture what's going on in the medium and small companies. So those two you should remember, even though you'll probably have a hard time remembering the real name. I do. I call them the Wilshire 5000 and the Wilshire 4500. And notice that MSCI, Morgan Stanley Capital International, and Standard & Poor's have competing indices. And who is Morgan Stanley Capital International? Next slide. But S&P is now managing the Dow Jones indices, so I can't figure out that. I just can't. If you can figure it out, please let me know. I'd be happy to be enlightened by what's going on between S&P, Standard & Poor's, and Dow Jones. Now, this next index is very important for small companies. This is the one that they normally look at when you look at small companies, and that's the Russell 2000. The Russell 2000 was created by Frank Russell Associates, and it was meant to measure the small company performance in the United States. And it's used as it's the most popular benchmark index for small companies. What Russell did is they took, let's take the top 3,000 companies in the United States, and then take the top 1,000 and pull them out of the 3,000. So you got the Russell 1000, the top 1,000 companies, the Russell 3000, the top 3,000 companies by size. And then you pull out the top 1,000, you're left with the Russell 2000. In other words, the 1,001st company upwards to the 3,000th company. And that's used when the media wants to talk about, and the financial media wants to talk about the small company sector. And a lot of people do watch that because small companies are the canary in the coal mine, so to speak. They get hurt the worst when the economy is ailing. But when the economy heals, they come out the quickest and usually more nimbly can take advantages of new opportunities than their big cousins and brothers and sisters. So all the ones we looked at were all domestic. Now, these last two, the Morgan Stanley Capital International, MSCI, you don't have to remember that. There's a little backstory with regard to that we'll take a look at in a second. But they had two indices for many decades, starting in the 70s. The World Index and the EFA. The World Index was meant to measure what's going on in the globe. And the EFA, and that's how it's pronounced. Maybe I've never heard of EFI index. I've always heard EFA. Europe, Australia, and the Far East. That was meant to be an international measure, a measure of international stocks outside. Remember, global versus international? Well, it was created by a division of the Capital Group. These are the people who run the American funds. Because they were investing globally. They weren't the only ones. They were investing outside the United States. T. Rowe Price, Templeton, which merged with Franklin Templeton. So these mutual funds and other investment managers were investing outside the United States, but they really didn't have any benchmark like we did for the U.S. to measure themselves. So Capital International started creating these benchmarks for global and international stocks. Well, that's a problem, right? Because they're creating the index that they use to measure themselves, a conflict of interest. So they sold it basically to Morgan Stanley. So they call it now the Morgan Stanley Capital International. The problem with the World Index and the EFA is that it's still only the developed world. Instead of starting to introduce the developing countries, developing economies, we used to call them the third world. We don't like that term anymore. It's not a very nice term. And they created two new indices that include the emerging markets, the developing markets. The MSCI All Country World Index and the MSCI All Country World ex-USA Index. I think it's actually All Country World Index ex-USA. I think I have to change that. I forget. But either way, I hate those terms. They just add into the, I don't know. I guess because EFA just stands for Europe, Australia, and the Far East. So they say, well, hey, wait a minute. We're now including Turkey, and we're including Latin America, and we're including Eastern Europe, and we're including Russia, and China, and India, and the Philippines. And so we don't want to call it the EFA, right? That's Europe, Australia, and the Far East. There's a cute little story that goes along with this. In the 1980s, the World Bank, division of the World Bank, the International Monetary Fund, wanted to create an instrument for investors around the world to invest in the emerging markets. Well, we didn't even have that term yet. So they wanted to call it the Third World Fund or something like that. And and because that's what it was still called. The Soviet Union and the Second World was the communist world, and First World was the West. And so they had a big presentation where they were trying to convince money managers and bankers and trust funds and pension funds and they were talking up their fund. And one banker got up and said, "Look, I think what you're doing is noble. I don't want anything to do with it because it's going to be really volatile. My job is not to lose my investors' money. But for God's sakes, sirs," it was mostly all men, right? "Gentlemen, don't call it the Third World Fund." And that's when you started to hear developing markets and emerging markets. So now, stock worksheet number 1, dear students. Make sure you do that because it contains the 8 indexes that you should know by name. The Dow, the S&P 500, the Nasdaq. Then the all country. I mean, it's not the all, not the all, the total stock market index. The Wilshire 5000, the Wilshire 4500, the extended or completion. So that's 5. Then we want the Russell 2000. There's 6. And then the Morgan Stanley Capital International, but you don't have to. All you have to be able to do is recognize MSCI, the World, and the EFA, which are being replaced by All Country World and All Country World Index ex-USA. Okay, so study those because we're going to ask you on the exam. But more importantly, when people use these when they talk about index funds and the like, and they talk about measures of the stock market, you should know what they're talking about. And then if they get into one of the more arcane, exotic indices like what's going on in Southern Jabip or something like that, you can, if you need to, look it up and say, oh, that's someplace you don't really want to invest in, is it? I don't think so. Slide 57. Oh, stock market index mania! Today's unstable stock market, folks. This is it. Look at it. Look at first the market skyrocketed northward until noon, and then it plummeted to the depths of despair at 2 p.m. and then ended pretty much where it started at 9:30. This is what you're going to see on the news every day, or on the internet, or the whatever financial media you gobble up. Consume is the term we use these days. But there's a wonderful book that was written a million years ago called How to Lie with Statistics. And this is one of the things that people use statistics to lie with all the time. What are they showing you? They're only showing you a little bitty piece of the index. If they were to show you the whole index, this is what you'd see. We call this stock market index ennui. You like that word? Ennui. It's a French word, but it's in the English language. It means beyond boredom. Because if we showed you everything starting at 0 up to 35,000, this is what it would look like. Do you think that's going to sell newspapers or sell internet eyeballs or television advertising? No. So they show you the mania, not the ennui. And so this brings us to slide number 59. Do you remember our volatility graph that showed the Standard & Poor's 500 for the year 2021? And we found that along with the little bumps along the way, as long as you held on to your money, you did actually very well in 2021. Here's the boring version of that volatility graph. That when you include the entire story from 0 up to whatever, 12,000, whatever it made it to, you see that it's nowhere near as volatile as people make it out to be, especially the nightly news. But what we really want to show you is 2020 again. And even though it looked horrifying when we showed just from about 6 or 7,000 up to about 12, 11,000, if we show you from 0 up to 12,000, you find that it's not so bad. Volatility is there, and sure, it can be scary, especially the world was ending with COVID. But take a long-term perspective, turn off the television, turn off your cell phone. Oh, no, you can't do that, can you? And just remember that next month when $100 comes out of your paycheck or $100 comes out of your checking account for your Roth IRA or 401k, or maybe you're building up a brokerage account that you're going to buy 10 shares of Federal Express, FedEx, you can live with it. And I get an immense satisfaction in the face-to-face class when we show this graph. Because why? You have some students who rightfully so are worried about choosing stocks, and they should be. Because it's, you can lose a lot of money, especially if you're reckless and go after every next big thing that comes along. But if you have a long-term perspective, if you are well diversified, you see that the volatility is not that bad, and you see people's faces relax for the first time all semester long. Just a few students who were rightfully so quite nervous about stocks, and so that's why I absolutely love this graph, and especially the 2020 version, because even though the market literally fell 30% in the fastest time ever, it came roaring back in the fastest time ever because of that stupid microbe that's still bugging us and probably will bug us for years to come. It's not going to destroy our civilization, but it will kill many people, sadly. But our economy will survive. I know it sounds like an advertisement. My apologies, but it's the truth, right? Unless the world ends, and then it doesn't matter where your money is. So, dear students, as we said, you will not see this graph on the nightly news. Remember, it's a long-term process. Keep a long-term perspective. And when the markets are falling, don't panic. Please don't panic. Okay, are you getting an education? I certainly hope so. We want to hear, what you have to say about our class. What's working, what's not working, how can we improve it? You have questions, you know who to contact. We are all, everyone at Southwestern, very proud, happy, honored, grateful that you're with us. And we wish you much success, and we want you to be rich. And who knows, this could be a exciting, profitable, rewarding, and I think it is, career, because the industry needs you. Okay, have I done enough advertisements for today? In our next presentation, dear students, we will, what are we doing next? I completely forgot now. Oh, finally, we're going to start looking at some measurements. We're going to start looking at some numeric numbers that we can attach to our stocks. Finally, right? We finally got to the indices, and now we're going to start digging. We're going to start peeling away the onion and taking a look at the numbers. Show me the numbers, as Mr. Benjamin Graham was wont to say. See you on our next presentation when we start looking at stock characteristics and measurements. Be awesome, dear students. Bring honor and glory to Southwestern Community College, your friends, your family, your colleagues, and yourself.